Welcome to the first of its kind exclusive webinar titled Overcoming Financial Hurdles for a Profitable Future. Finance is the backbone for any business to survive. And in these unprecedented times of COVID-19, cash flow has reached the lowest ebb and is destined to affect the gem and jewelry trade for some quarters now. Finance management has become the most important ingredient without which survival would be very difficult. We all need advisors, mentors, experts in the field who can guide us through these tough times. That is exactly what our esteemed speakers, Mr. Manoj Chawla, Mr. Jeff Rhodes, and Mr. Nirav Shah would be doing today, educating and guiding us to a better tomorrow. It is indeed a pleasure to have Gautam Shashital. We all know an industry expert and a mentor and a finance professional who has seen the industry moderate today's session and guide us to a logical conclusion. May I have the privilege to invite Gautam Shashital to introduce the speakers and open the webinar. Thank you very much.
Thank you very much, Subbu. This, as you said, was the third in a series of Spring Back webinars. I particularly like the name Spring Back because we're not talking about the doom and gloom here. We're talking about how we as an industry spring back from this to doing bigger and better things. Thank you, Ashish, first of all, Ashish Garg, for conceptualizing this, and to the New Jeweler Media Group to sort of so ably develop and curate this series of webinars. So thank you very much, Ashish. Thank you, Subbu. Thank you, Anand. And again, thank you, Nirupa. I don't know if Nirupa Bhatt is on the call, for moderating the previous two seminars so ably. Now, most importantly, I don't know how many people we have here today, but thank you all for spending your afternoon with us. And we look forward to your questions. To make this whole seminar much easier, we're going to talk first. The panelists, I'll ask questions of panelists, I'll answer them. We will spend a maximum of 1 hour talking about the issues at hand, and then we will have a dedicated half an hour of Q&As. However, you can keep asking the questions throughout the 1 hour. Don't wait for the 1 hour to end, so that we're taking your questions on a regular basis and answering them, collating them and answering them as quickly as we can. So the first two seminars were about, the first one was about the industry bracing for a new normal post-COVID. And the second one was talking about supply chain disruptions and its impact on the industry. Now, let me summarize very quickly the key themes that emerged from these two webinars, because that's very germane to what we're discussing today. Number one, the first theme that emerged was businesses have to be more conservative about expansion and growth. Number two, business owners need to put more equity, i.e. more cash, into their business, focus their cash on their core business of jewelry manufacture, diamond trading, whatever it is. So bring back the cash, put it in the business, create more liquidity in the business. Number three, focus on finances and people and manage out discretionary expenditure. And the last thing that I picked up from the previous two seminars was we all have to be prepared for a sustained slowdown in sales and markets. Today, we're going to talk about overcoming financial hurdles for a profitable future. So what we will address is how the industry can insulate and strengthen itself financially during what may well be a sustained slowdown caused by COVID, caused by a slowing economy, caused by travel restrictions, and caused by much reduced tourism for the rest of this year. So first of all, let me introduce our eminent panel for today. Mr. Manoj Chawla. Manoj is the Group Chief Risk Officer at Emirates NBD. But more importantly for me, a very dear friend. We've known each other for an almost generation, Manoj.
Yeah, 30 years.
So we're very old friends. Indeed, yes. The second panelist is Jeff Rhodes, who I think everybody here knows, another good friend, and perhaps the foremost expert on and advocate for the bullion industry in the UAE. Welcome, Jeff. And then we have Nirav Shah, who is a diamond industry expert, who used to be previously the CFO for the Timex Own Group, which is one of the largest diamond groups there, and now is the MD of an advisory, FAMA Advisory, which supports a large number of diamond and jewelry players. And of course, I won't leave Ashish Garg out. Ashish, I can't let you off the hook. There will be some questions addressed to you as well. So, what we don't want to do today is look at the doom and gloom scenario. We want to address the opportunity. We want to use the slowdown to do things differently. A webinar from 3 different angles. The first angle is we're going to first look at the general economic outlook and what the banks are looking for to support the industry. The second part of it is we're going to look at the industry's needs at this stage. And then finally, third part of it, we're going to look at, well, how can we work as an industry to help ourselves? How can the banks help us? How can we help ourselves get the banks to help us? So, Mr. Chawla, can I ask you the first question? Can you give us a view on the general economic outlook for the rest of this year and into 2021? What is your outlook and how can the industry be prepared for this?
Thank you, Gautam, and thank you for firstly having me on the panel. And I would be pleased to share my views. So first, I'll start with a small statement, and I would, for a moment, like you all to reflect on it in your own ways. You know, what really the pandemic causes is it pauses the present and focuses us immediately on the future. This is something we never planned for. I think we should also be prepared to see the pandemic, which will phase out over a period of time, not disappearing overnight, and a new normal where most things are different. And it is as much connected, the industry and the banks are all connected in this entire ecosystem. Over the past 4 weeks, you would have interacted with several business owners, retail analysts, economists, real estate experts, and I'm sure you've got many different opinions. But if I was to sum up, if I look at all the takeaways, it points to a little bit of uncertain story about the future for all of us. I think we are entering into a new evolutionary state of consumption, where potential exists for big companies to get bigger, while the smaller retail chains may have a little bit of an uncertain future. To a large extent, you're already seeing this around you. Your patterns around travel, dining, shopping have already been transformed without your doing a lot of effort about it. And these have been forced by the ecosystem around you. And it is unlike anything else we've experienced in the past before. I would, however, say that while the forecast may be a bit uncertain, there is always a silver lining and there will always be new opportunities. And that is what all of us always endeavor for. In this phase, we are already seeing new ideas emerging. And to Gautam's question on what is the outlook and what should we be prepared for, today, I think what companies really need to prepare for, first and foremost, at least on my agenda, would be cost management. And I know all of you would be doing this. You all are experts in your field in any case. But amongst the many variables you have in a business, the revenues are largely uncontrollable at this point in time. So you can only control what is within your own domain, which is more on costs. And this result, also bearing in mind, I think we should be prepared to see a reduction in the spending power going forward, especially relating to gold and jewelry. On the other hand, there will be some pent-up demand which builds up during this time. So that is what is the silver lining and the hope. Clearly, during this period, there will be new ideas and new winners. This means there will be a new normal for consumer behavior, possibly moving more onto online digital channels, where logistics is also going to be a key part. E-commerce will clearly grow faster than ever before, and the industry needs to be prepared for this. And e-commerce will encroach all areas of retail and the industries, and perhaps there is a need to think of new approaches and practices and I will talk a little bit more about this. UAE in particular and Dubai in particular tends to be associated very well with gold and jewelry, and that branding should continue to help consumers become more selective in what they source and from where they source. And I think in that there is at least some advantage here. I think the businesses will also need to examine their business models, the supply chain, in the light of the changing customer behavior and the price points where sales may tend to happen in the future. I think the COVID-19 precautions apply to all of us, health and safety, will continue for some time. This, I think, also has a bearing in the industry, which I'm sure you all are thinking about, in that the look and feel of the article, which was a very integral part of the purchasing pattern, may tend to change. So the industry will have to go about thinking on sanitizing requirements. Stores could face new demands like installation of temperature-taking devices, sanitization controls, which have not been the norm so far. It is therefore important to make the right investment into good costs, digital good workers, e-commerce channels, and clearly avoid all the unnecessary costs. I would say, I would end by saying to this that the industry now, more than any time before, should have a frank and open conversation with all stakeholders, suppliers, employees, bankers included, to ensure that these stakeholders move together, and most importantly, with a shared understanding, because we all are in this together. During this period, we all hope and pray at the end and in the not too distant future, things will improve. We also have to remember that cash is going to be one of the most important assets you hold right now. So, Gautam, that's where I would answer your first question.
Fantastic. That's excellent. So you talked about costs, management, you talked about good costs, and you also talked about basically all of us being in it together. I think that is a very, very important point, Manoj. Thank you. I'm going to ask you a follow-up question. The UAE Central Bank announced TESS, which is a targeted economic support scheme, 256 billion dirhams. And I recall reading that the UAE Central Bank governor urged the CEOs of banks to extend helps to corporates and SMEs. Now, a lot of the players, retailers in this segment here in Dubai are SMEs, for instance. I'll add another thing to that. I remember seeing an article from January when His Excellency Saeed Sultan Al Mansouri, the Minister of the Economy, said that the UAE is highly competitive in the gold, diamonds, and precious metals trade. In fact, this is one of the most important sectors supporting the UAE's economic diversification efforts and the promotion of the country's non-oil foreign trade. So really, if you put these two together, the question for me is, how much of this 256 billion will trickle down to our industry, given that it is such an important and a very critical sector for the UAE economy? And what support can banks give to tide over the short-term crisis of little or no revenues, build-up of inventories, fixed and variable costs, and of course, more importantly, the people costs. There's an economic cost as well there. So back to you, Manoj.
Yeah, thank you. Thanks, Gautam. Firstly, I think the government initiatives and central bank initiatives have been very timely. These were announced soon after the situation started escalating and the pandemic started getting worse. So to explain the 256 billion, and there may be, I'll try and explain it slightly simply. There are two parts to these initiatives. The first part really is directly focused on the bank and its customers. The second part is more focused on easing certain capital and liquidity issues in the banks. The first part of the initiative is about 50 billion. The rest of the initiatives are in the second part, and the second part also indirectly flows into the economy and into the customer base. Now, I think, I'm sure at the end there will be a question, so I'd rather cover that before. The way the allocations of this 50 billion have been done across the system has been very fair. Central Bank has reviewed certain returns which the banks submit, and they're not focused on industry A or industry B or industry C. It is a common level industry return. And on basis of that, each bank has been allocated a share of this. You would have seen also a significant part of that has been drawn down by the banks. In technical terms, this is known as ZCF. It's called zero cost funding. Now, what is it primarily for? I think if you are dealing with your own banks, you would have seen the banks are quite amenable and willing under right circumstances to defer certain principal and interest payments which are falling due between now, which is this initiative really starts from 15th of April or even 1st of January. But let's say most banks are looking at it from early April, from 1st of April or mid-March till the end of the year, of deferring these installments to ease the cash flow position at the customer level. In return, the banks get a so-called replacement cash flow, which is the ZCF, and which is the test support from the central bank. And that process is working well. I know of a number of banks, and here we will not go into specific banks or specific issues, but that process, to my knowledge, has been working well. And because I tend to see the daily report on how many deferrals, etc., are taking place, so that process is fine. Now, moving to the second part, I think the banks, independent of, so there is a finite pool here. But I think the size of the problem or the issue which we may be grappling with may be a slightly bigger one. So on the other hand, through the central bank auspices, there is relief on the capital and liquidity requirements of the banks, which makes in turn liquidity available for fresh lending. And while banks have to manage capital ratios, you know, we are in a global world. So all the capital requirements, the IFRS 9 requirements have to be managed very carefully. You would have already seen the local bank results being announced, and first quarter banks have had to take substantial provisions to deal with what each one sees as the outlook. So that is on the entire TESS part of it, which is the Targeted Economic Support Scheme, for those who are not familiar with the acronym here. Then moving on to, besides the TESS, the banks are willing to support customers on debt maturities, and again, easing up the cash flow. But I think that is one part of it. I think on a case-by-case basis, banks are open to additional funding, because in turn they have funds which have been released. I know the jewelry sector has raised some issues around acceptance of jewelry as a funding tool, and I think Jeffrey will perhaps allude a little bit more to it in his session. But I think we do need to sort of be slightly more innovative around funding requirements. I recently just came across a hotel ad, and this was in New York City, just saying that you could buy a voucher today for 100, and its deemed value was about 130, let's say, for available for a full year. So you could use it at any point in time, and they were using this through their customer base. So, I mean, it's a thought. I'm not saying that we do need to apply it to this particular industry, but it's a thought. I mean, they were just dealing with what they understand as the problems and the cash flow squeezes which are there, and they came up with a slightly innovative solution around it. And for banks, they obviously will continue to review the cash flows, the inventory positions, and they have overall supported the industry so far. I mean, it is a very important part of our ecosystem and the fabric of Dubai, as well as UAE. So that industry has to be supported all the way through. There could also be transaction level financing. We have not discussed this in the past. I think banks would be open in the right cases to looking at transaction level financing. There could also be liquidity pools created through discounting of receivables based upon a bank's understanding around those receivable pools. So these are slightly technical areas, but I'm sure we are, as I said, the present simply stopped and we were pushed into the future. So we have to be innovative about this.
So what you're saying, Manoj, is we're all getting touchy-feely, discovering how we can go about this, but that there are several tools available, which goes back to me summarizing what you said, which is about effective cost management. There will be certain additional costs that the industry is going to have to bear, such as sanitization and so on. So it's about managing good costs. And most important point that you made there is to say that the industry needs to connect with all its stakeholders, whether it's customers, suppliers, bankers, or whatever. On the second part of it, it's very heartening to know that the ZCF some of that ZCF will actually be deployed towards this industry, but it's on a case-by-case basis. So it's not a freebie, a free-for-all that everyone's going to get. But I think what this, as you said, is because we're being pushed so rapidly into the future, what the banks will be and should be looking at is more widening the basis on which they lend, whether it's securitizing receivables, securitizing inventories, and so on, apart from the traditional unsecured lending or based on inventory that has been done.
Yeah, just one point, Gautam, I'd add on. So I think that's an excellent initiative by the central bank. But for the clarity of the audience, the deferrals are much beyond the availability of that with your banker is a lot more. So both the sort of tracks will work in parallel, both the test track as well
Indeed.
as the rest of the track.
Indeed. And the banks will obviously be willing to talk to each customer on a case-by-case basis to see how they can open out their own liquidity apart from deploying parts of the test towards the industry. Excellent.
Yeah.
Thank you very much, Manoj. That was very enlightening. If I can move to the second part now of our discussion, which is what does this sector need from a financial viewpoint? Now, there are various aspects to this very vibrant industry here in Dubai and in the UAE. We're talking about diamond trading, wholesale diamond trading. We're talking about precious metals, bullion trading. We're talking refining. We're talking about jewelry wholesale. We're talking about jewelry retail. There again, we get into gold and diamond jewelry. It's going to be extremely difficult for us to manage all aspects of it, but we're going to try. Again, let me remind the audience, please keep your questions coming. We will answer them after our discussion is over. Let's remember the context before we go to the questions. The sector is almost at a standstill today. Retailers are probably sitting on large amounts of unsold inventory and potentially facing a slowdown for the rest of this year, given the economic slowdown we're expecting. So at this stage, let's openly look at what the sector needs before we can get into the last part of discussion, which is how do we bridge that gap. Now, first of all, can we hear your views, Nirav, followed by Jeff, on what we need as an industry from a financial viewpoint today? Nirav?
Thanks a lot, Gautam. And thank you to the organizers and Ashish for putting me on the panel today. See, if we keep our context, like you said correctly, on the current issues and what we need to do, what we call this is that this is the new normal that we are into. So now let's look at the immediate issues, which are next month or so. And we all know that there are not going to be revenues in that time. Then there will be a period of next 6 months or so where the revenues are going to be much lower than what we are used to. And then there is going to be another period till say end of next year where the things might come back, to somewhere, it's 70-75% of what we used to have. So having bucketed ourselves into this 3 period, we need to put down our revenues and our cost estimates based on this and get adjusted this new normal level. And therefore, like you said rightly, that we are sitting on a huge pile of inventory in each portion of the segment, be it wholesaler, be it retailer, be it bullion, or be it diamond or jewelry retailers. Everybody has certain level of inventory which may be excess from a current point of view. What is key today is the cash and managing our cash flows and managing our immediate and next 6 months cash flow requirements, and therefore one needs to critically analyze what are the costs which are must have, including the additional costs which you highlighted, like the sanitization and few other costs. What are the costs that are good to have in terms of senior people and other resources that we need, and what are the excess costs that we don't need to have given the current scenario, and do a relook at your own expenses and revenues, set your levels of inventory at that level, at the new normal, and then start looking at how best you can monetize those inventories which you have. So fortunately, large part of the industry is sitting on gold content, and gold prices have gone up. Is it something that you can take advantage of and balance some of the cash flows that you need at the moment to survive and pass through this period? These are tough questions. I'm not saying no to that, but these are the things that one needs to start looking at and being more and more practical about it, because cash is going to be crucial. It is crucial for 2 things. It's crucial for you to survive this period till the time a new revised activities are coming in place, and it's also crucial to take advantage of the opportunities that you will get in this period, because as we all know, the challenges are the maximum, and at that same time you get the best of the opportunities, which if you take it correctly also will help you steer through this period very, very well. So I would kind of say very simply that this trade is very passionate about the material. The time is not to be passionate or to be attached to the inventory. It's to be more realistic, get to a new level of inventories and use those in form of cash flows to bring yourself back into the new normal, and then allow you also to take care of the lots of opportunities that might come your way in this time. But only if you're agile that you can take these opportunities. Only if you're financially disciplined that you will be able to take these opportunities. So that's the key that I would like to kind of, convey. Jeff, would you like to add to that?
So I think before Jeff comes in, let me ask very quickly, extremely well put. Again, the C words are coming in: cost management, cash. And you raise a new important point, which is about the industry is possibly sitting on a large quantity of gold, jewelry or gold,
yes,
which can be monetized at, what was it yesterday, $1,725 per ounce? Jeff, you might want to allude to this and what's happening in the refinery sector. Is it easy for us to melt, convert into cash, and so on? So I'll hand over to Jeff.
Yeah, well, first of all, Gautam, thank you very much, and thank you to the organizers for this webinar. I am 68 years of age and a complete technophobe, and so one of the big benefits of the lockdown has been the fact that I can use Zoom. I didn't think it was possible, and also I can reach out to literally hundreds of people in one meeting. I mean, normally this time of year, Gautam, we would be having the Dubai Precious Metals Conference.
Indeed.
And everyone gathering together in Dubai from around the world to do something like this. And I think, technology is a wonderful thing, which brings me into really the key part of what I want to talk about, which revolves around technology. But I do see two aspects. One is immediate, and one is over the slightly longer term. But certainly, as I say, there is a short-term problem. And that short-term problem is that many jewelers have facilities from their banks, and because the gold price has risen, they would have a margin call. And normally they'd be fine because they'd be selling their jewelry at higher prices and, of course, have the cash flow coming in to make those margin calls. Now, the shop's not open or haven't been open. And now that they have reopened, it will be pretty sluggish in terms of making sales. And so I think an immediate issue to support the industry by taking some short-term steps, but using the asset that the jeweler's got, which is gold jewelry. It's there. And that gold jewelry could be used for immediate kind of solutions to raise finance from the banks. And, I'm talking generically, not about any one bank or a few banks, but generically making that asset that's sitting in the store not being sold and using that to raise finance. Now, that structure would involve taking jewelry and putting it in a vault. And that vault would, the custodian of the vault, say a Brinks or a Transguard or whatever, would then give the bank the comfort that there is collateral sitting there, and the bank would then give facilities against that. Now that is something immediately that's needed, and the Dubai Gold and Jewelry Group is working on this kind of structures to help the industry. But I'd like to move on to the second part, the longer term. And before I look at the future, if you forgive me, I'd like to look back at the past, because I was here sitting in my office at Standard Bank in Khalid bin al-Walid Street in September 1999. And that weekend, the European central banks made their comments, their statement that they would restrict lending of gold and they would restrict selling of gold. Now, this was really a turning point in the history of kind of official, the central bank approaches to the global gold industry. From 1980 to 2001, largely, we were in a bear market. And every time there was anything like a rally, you had central banks selling their gold. Famously, the British sold 2/3 of its gold at an average price of $286. But you had central banks selling gold and gold mining companies hedging. So there was no chance. Anyway, on this weekend, 26th of September, we had this announcement. Well, the gold price went from roughly $255 to $340 in no time. So that increase of 30% plus put this industry in Dubai in a very, very difficult place, because of course that 40% increase meant that because of the way gold loans were given, 40% less gold was available from the banks to the gold jewelers. But of course, they still needed the gold to sell. And so I sat there at an emergency meeting with 3 or 4 people, and it was incongruous to me that we've got a gold price going up 40%, which meant that the gold in the jewelry stores was worth 40% more. And so it occurred to me then, and to the people sitting with me, this is a nonsense, because the jewelers have got a lot more money. It's just not in a fungible form with their bank facilities. And at that point, we started talking about there must be a better way. And then along comes technology. And technology has given us the ability to use new technology and link it to inventory. And rather than putting jewelry in an actual vault, you put it into a virtual vault. And that virtual vault is made possible by technology. And so my strong recommendation going forward is for jewelers to make use of their key asset, which is gold jewelry sitting in the store, embrace technology, talk to the banks about new forms of financing, innovation, as I say, driven by technology, driven by the fact that now in the UAE, you have a mechanism to formally record transactions, lending and borrowing between the financier and the client that requires the finance, who has gold jewelry at its disposal. And so what I'd like to say, for a profitable future, please embrace technology-driven inventory finance, working with banks here in the UAE to make things much more flexible. Now, I was use an unfortunate term regarding margin calls, which I've been advised not to use, and so I won't, Mr. Gautam. But the biggest challenge facing anyone running a business is managing their cash flows. And the one thing that is outside of, apart from actual sales, the one thing that's outside of their remit is the direction of the gold price. Now, if you follow my advice and have technology-driven inventory finance, you would have gold loan financing secured by gold. Gold jewelry on the one hand, XAU gold financing on the other hand. And as long as you have a period of time that you fix a gold loan for, you have no margin call. You can be certain that you're not going to get a call the next day asking for cash, because your collateral, which is in the virtual vault, which is pledged to a financier, is hedging itself exactly with the gold loan structure. So
this is
as much up and down.
So this is as much a message, Jeff, for the industry as it is for banks.
Yes, but
embrace new technology.
But the banks have got it. In the UAE, this is now a standard product. This is not future. This is standard. What we haven't got is the industry embracing it. And so, my message to this webinar is not addressed or directed at banks. The banks are doing a great job. And to Mr. Manoj, I think, and to the banking industry generally, I think the way the banking side of the market is really supporting and will continue to support the industry. But this embracing of new technology that facilitates inventory management, as I say, put simply, instead of putting jewelry in an actual vault, have it in a virtual vault, available to be sold to clients on a day in, day out basis, and not leave yourself open to margin calls and the impact those margin calls can have on your cash flow. Thanks, Gautam.
You were very, very, in a very simple language, and I think most of the people would have understood, your idea. And I think it's fantastic. We obviously need to get into technology and use technology to definitely, get out of this, the situation that we are in.
Yeah, as I say, but my thrust of what I'm saying is the medium term. Not there's an immediate issue with margin calls. There is, okay, yeah. And so I addressed that in the first part of what I was saying. But the second part really is for the industry to embrace technology-driven finance, technology-driven inventory finance. The banks get it, and the banks provide these facilities. to its clients, and it just needs the industry to embrace. It's not, look, it's not the answer to everything, but it's a step forward. Apart from the fact that margin calls are actually eliminated during the period of the drawdown, but secondly, for if you're running, it's not just for SME, but if you're running maybe 50, 60 or more stores, this helps you with your inventory management. And even if you've got your own store, you know through this technology, like every morning or every evening, exactly where you were at the start of the day and where you are at the end of the day. So you can manage inventory, and you will have a lot of cost savings from that. And so, as I say, for me, there are other benefits, not just the financial benefits, the management perfect, of your Jeff. Business.
That's perfect, Jeff. But the only challenge that we have now is that how do you implement these technologies? And there's always a time lag between when you start implementing, when it is ready for you to use. So that's where we have some amount of gap which is coming in, you know.
This is exactly why I said I have 2 points. One is immediate.
Yes.
Right. The second one is more medium term.
That's right.
Okay. Now the product is being used significantly in the UAE now. Okay. But if we found a new customer, the onboarding and the technology, the implementation of the technology, it takes a while. And so that is for the medium term. And by that, I mean from now, 3 months. If a client decides, yeah, I want to do it, 3 months time, I'm sure it would be possible. Now, what's happening in the next 3 months?
I understand. So what I also am mentioning here is the twofold of thing. That one is there are a set of clients which are ready from a technology perspective to share this kind of a thing. And there are a whole host of other end of the client which have not embraced technology so far. So they are not yet ready with the information to share with the financial institution as well.
Absolutely.
So that's the two things. Gautam, can you?
If I can, yes, I'm back. If I could just say, but thank you for holding the fort in my absence. My network just went down. Yeah. Technology is good, as you said, Jeff, but not when it's not working.
Yes.
Actually, can I just say, Gautam, you make a very, very good point, because in a technology-driven inventory management financing structure, okay, technology is important, and having fail-safe technology is crucial. And so, sorry if I can finish. And so the structures that are currently in place have in place the backstops, have in place the fallbacks in case what happened there.
Absolutely.
So and just to recap, Gautam, my fundamental points were: one, short-term, immediate solution.
Yeah.
Okay. Jewelers have jewelry and they have margin calls.
Correct.
And they're struggling to make the margin calls because they don't have the cash. And so we need an immediate solution to turn that. Now, a solution is being worked on by the Dubai Gold and Jewelry Group and others to actually deliver to the market that need today, not in 3 weeks' time or 4 weeks' time, maybe in a week's time. And so that is underway as I say, being driven by the Dubai Gold and Jewelry Group and involving the people you would normally be expected to be involved with. But the heading of this seminar is looking to a profitable future.
Yep.
And my technology comments are about the future from 3 months onwards, 3 to 6 months onwards.
Yes.
Fantastic. So really, I think both of you talked about the 1 month, the 6 month, and the 12 months. But before I summarize this section, Ashish, this is the point at which I pull you in. Give us a view on the diamond industry and what's happening over there and what it needs to do at this stage to prepare itself for the future, the long term.
Okay, so see, diamond industry, currently, if you see, it's all about the supply game. we are currently seeing with all the news which are coming in, that there would be a supply curtail from the miners. So if we are seeing a lot of supply curtail in the pipeline, there would be a chance that our product, there would be a lesser inventory in the pipeline 6 months onwards. Because obviously the short term, there is pains and everybody accepts that. And everybody is talking about that. There is definitely certain short term pains like cash flows and all that will be coming in. But if I look at my industry and our product, there are two things to it. First, we are a non-perishable product. So if we are a non-perishable product, we are better off than other industries like fashion, chemicals, textiles. So we are more bankable in a long run. Secondly, we are, in economic jargons, what we call a Veblen product. A Veblen product is something which increases its demand when its price increases. So now with all the miners, curtailing the production for next 6 months, and a lot of Indian manufacturers and the import in rough in India would also be voluntarily stopped for a few months. And thirdly, there would be a lot of manufacturing slowdown because of the restrictions, social distancing restrictions placed at the factories. So I feel there would be a lesser inventory or the lesser polish being produced for the next 6-7 months, which will definitely, firm up the prices of the diamonds in certain categories. And that ultimately will make our product more bankable. And then, as I said, our product has an intrinsic value. It's a Veblen product that it increases the demand, increases prices on its demand. And then it is non-perishable, has a real tangible value against any other investment vehicle. So if you look at that basis, we are much more bankable than any other, product or any other industry. And that's where I feel, we will, in a long-term basis, will be able to attract financing on our side.
What you're saying, therefore, is that it's the short-term staying power that the industry needs to have for the next 6 to 9 months. Goes back to the point of cost management, cash flows, ensuring that you sort of ring-fence your cash and you're protecting it almost.
Correct.
Because when it comes up, you'll have that big spurt, which is quite the opposite of what Jeff is saying. As far as gold is concerned, at $1,725 an ounce today, this is the point at which they should liquidate or at least use that as collateral and prevent margin calls. Does that make sense? Is that a good enough summary?
Yeah, look, for me, Gautam, I don't advocate selling gold ever. And if you're in the jewelry industry, typically you're a gold bug because you love gold.
Yeah.
Okay, and many of the jewelers, you made the point, they have been sitting on their own inventory, their own capital held in gold, and so they've had a very nice run up from around $1,200. Yeah. I think most jewelers would be holding their gold at $1,200, and now you've got gold at $1,700. That's fine. But if you have a good business model, you're getting a good return on your capital. Obviously, if you can borrow more capital, you can make a lot more money. Yeah. And what I'm saying is borrowing from a bank using existing products that are in the virtual vault, held in a very secure way to give the comfort to the financier. This is win-win all around. The financier has a much more, if you like, a stronger, easily identifiable collateral on a day-to-day basis, and the jeweler is using its product that it still owns as collateral and is able then to grow his business. And so, as I say, I think we have a wonderful business. Just from a macro perspective, you should know that in 2019, 61% of all newly mined gold went into the jewelry sector globally. The jewelry sector is absolutely crucial to the health of the global gold industry. And the UAE is one of the most important markets in the world, in the jewelry sector, and in the wider gold market. And so my message to everyone, it's not doom and gloom. We are at the epicenter of the global gold industry. And as it recovers, everyone will do fantastically well.
Fantastic. And this is what I'm hearing from you, Jeff. This is what I'm hearing from Ashish as well as from Nirav. Here, what I would do is, Jeff, I'm going to be a bit cheeky. And typically on the 18th and 19th of April, you would have been sitting there and giving us a view on the price of gold at the year end. You've not had the opportunity to do that this year because of the postponement. So what's your view on the price of gold at the year end?
Okay, to those people who listen to Dubai Eye 103.8, I had an interesting conversation with the hosts, and in that, and this was about a month ago, maybe longer than that, maybe 6 weeks ago, and I gave the view that this year we will see a price north of $2,000. And those that know me will know that I'm really not in the habit of like hyperbole, I'm normally just within certain parameters. I then subsequently, on 2 or 3 occasions, was challenged. Well, when are we going to see $2,000, Jeff? When are we going to see $2,000? Well, I don't know that we are. I think there's every chance, but certainly I would be very surprised if we didn't see a gold price of at least 1850 between now and the year end. It'd be very difficult to call a year end price, but certainly people of a much higher pay scale than me in the world of gold, the JP Morgans, the Goldman Sachs, the Banks of America, they're all looking for a price north of $2,000. And as I say, I'm on record as being in the camp. This is a bull market. This is an old-fashioned bull market. They don't go in a straight line, but you buy dips, take profit on rallies. Correct. And those dips now, honestly, the base, it was 1,400, and before that, 1,300 and 1,200. For me, the baseline is 1,600, and that is a sign of a gold market. So my advice to the industry, when you're managing your business, don't leave yourself exposed to gold prices going up, because I think over time they will go up significantly.
Yep, fantastic, thank you. So let's move on now to the third and final part of our discussion. How can we bridge this financing gap? Obviously through self-help, as well as support from lenders. Now I'll start here with, say, Manoj. Manoj, you've been quiet for a while. Some views, and then move on to Neeraj and then Jeff. But really, as we've heard so far, the industry has typically relied on gold loans from banks or the financing of sites in the case of diamonds. Are we missing a trick here? Number one. Number two, does the structure of the industry need to change to enable more lending? And Nirav, you have some views on that, I think. Number three, should the industry limit itself to traditional ways of borrowing like gold loans or unsecured funding? Should they do something different? For example, should your suppliers be lending to you or giving you credit based on LCs? And I don't know if the industry has ever exposed different ways of doing it. We've heard a bit from Jeff about technology and to an extent RFID. We can address that in this session as well, Ashish. So let me start with you, Manoj. From a bank's point of view, how can we bridge this gap? How can we be more innovative as an industry? What's your view?
Yeah, no, that's a good question. And I think it connects with a thought which we've often had and discussed, or I've had discussions with Gautam around the industry in a more generic way, the entire gold and jewelry industry. I think, how do we make the sector, frankly, more bankable for the banks? And I think one of the keys to that is the transparency factor. So whether we go with Jeffrey's virtual vault, but the fundamental point is getting more transparency into the industry. I think the bank should become more of a partner together with the business, where problems, issues are discussed in a more open forum and shared with due secrecy borne in mind, because the industry often tends to know the issues much better than the banks get to know about them a bit later. And at times of stress, I think banks would also expect some form of equity, assets on the ground, the confidence factors which are quite critical for financing. So the first point would be around transparency. I think in the short, medium, and longer term, I think we've talked about really meeting cash flow obligations, and where those cannot be met, discussing through and fixing time schedules which can thereafter be met. Medium term, I think industry will also need to look at its store locations, etc., as part of that cost management plan, because overall the spending and consumption patterns will change quite a bit. And I think I completely agree with Jeff on the embrace technology, because, and it's also further connecting the buyers, factories, customers, banks all together, because I think somewhere we will have to get to that particular state as we get more and more transparency is. I think there is a need to review the business model post-COVID, because, and I think that should also be with stakeholder engagement. Maybe the stocking patterns do change. I can't say that I can't predict that part of the future, but I think there is a need to revisit the entire business model and clearly sort of discuss through on risk appetite issues with the banks.
Excellent. Thank you, Manoj. So transparency, partnership, more equity on the table.
Yeah.
In summary. Excellent. Shall we move on to you, Nirav?
Yeah. So fundamental point with the industry in to be more bankable, and you want to embrace transparency, the main issue that we are facing is the corporate structures. So one is that industry needs to embrace and adopt more and more corporate structure, which banks understand well, provide them with the financial statements, which are as per the latest IFRS and other accounting standards, which does take into account the stock valuation, the methodology, and how we are, coming up with the numbers and giving more accurate picture of your business. These are the two things which are key to bring in more transparency in what we are submitting to the bankers. Okay, so these things has to change. Only if this thing change and somebody can start believing the numbers presented in the way that they are presented and the fundamental the reasons behind it, that you can then look at more sophisticated credit tools like LC and few others. You can start using that more frequently and bring that entire flow of capital in those accepted form of lending into the sector, which is not there today. The fundamental issue around that also is either the absence of the corporate structure or absence of reliance on the financial statements, in one way or the other. That's the key that one needs to make sure. One, we have to adopt corporate structures, adopt the latest best of the practices when it comes to accounting, revenue recognition, inventory valuation, and all of that. That brings us to the transparency levels. And once we have that, we can definitely look at much more being more acceptable from a banking perspective to use more traditional ways of funding.
So what I'm hearing here I heard a bit of it from Manoj, I heard a bit from Jeff, I heard a bit from Nirav. What we're saying here is that a lot of what we're hearing is there's got to be more investment in technology. There's got to be more online selling, for instance, more transparent corporate structures, IFRS and best accounting practice. Are we saying here that the only ones in the industry who can survive are the bigger players and you'll have a shakeout happening? It's not germane to the conversation today, but this is just something I'm throwing out over there.
Which is normal with any kind of this situation of pandemic or crisis or, We had that in the financial downturn in 2008-9 also. We had shakeout. But again, if you see the pattern of players who moved out were the ones who were not able to manage their finances well.
Yeah.
And that's what is also going to happen this time also. That's why I always say that the cash is going to be crucial. It's going to allow you to take that opportunity also, and it's going to allow you to survive you better also. The financial discipline and prudence is the key.
Yeah, absolutely. Batten down your hatches, be sensible, manage your costs, your cash there, collateralize your inventory.
Yeah, Jeff has a point there.
Yeah, Jeff, go on. I'll move to you, Jeff.
No, okay, a key point was just made about not really being able to trust balance sheets.
Yeah.
And for whatever reason, because maybe it was framed in such a way as that the banks don't understand balance sheets. I would challenge that quite strongly, having worked for bullion banks such as Sammy Montague, now HSBC, Credit Suisse, and Standard Bank, between them for about 30 years. And I can tell you banks understand balance sheets very well. But the problem is, can they believe in those balance sheets? Maybe yes, maybe no. This is the fundamental reason for developing technology-driven inventory finance, because the balance sheet will give additional comfort. It will definitely help. Good reputation for the client, a decent balance sheet, definitely. But fundamentally, what is the collateral for the financing? It's the gold jewelry sitting in the virtual vault, which is collateralizing a gold loan. Gold against gold. Seriously, nothing like it. There is a certain element, you have to be a certain size for this to make financial sense. I think that's definitely true, but there's no reason why over time that can't be filtered down, and so that even the smaller guys can participate. We're all clever enough to find a solution to that, but ultimately, you know, you get away from this uncertainty about balance sheets, and you have the certainty of inventory that's there every day. You can see it. Gautam, I'd like to pick up on the LC side of it that you mentioned.
Yes, I was just going to ask the question. Yes.
No, I have over my time been actively involved in this kind of thing, not from a jewelry perspective, but from a bullion banking perspective, i.e. supplying bullion bars in a large scale against LCs. Okay. And I can tell you that I never did very well at that. And I remember having one LC that took me, it was a 360-day LC that took me 320 days to discount. So, so I think the gold industry, there are certain types of flows, you know, big flows between different bullion centers that can be financed with LCs. I would have thought that the kind of complicated nature of LC type business isn't necessarily suitable for the jewelry trade. And I want to finish with one point, and this is a personal observation relating to my own family. And I've been taught, I've got 2 sons and a daughter, right, who are struggling in the UK because suddenly their income flows have gone, but their outgoings haven't changed. Now, what don't they have? They don't have a backup cash flow plan. And so, as it applies to them, applies equally to all industries, including jewelry. Make sure you develop a cash flow reserve that can see you through for at least 12 months.
Rainy day.
We are, for that, save for the rainy day, put it to one side. And then you don't have to sell when you should be buying, and selling and buying when you should be selling. Let your decision making be determined from a position of strength, not a position of weakness because you haven't got any money.
Yeah, fantastic. Gentlemen, I'm going to summarize this and we'll open it to questions now. These questions have been coming in thick and fast. So what I've heard here is transparency, partnership, and more equity in the businesses from a bank's point of view to give more confidence to the sector. We heard from Nirav about embracing transparent and less complicated corporate structures, more transparency in the financials, IFRS accounting, inventory valuation, etc., etc. From Jeff, we heard technology adoption. We heard about reputation management, decent balance sheets, and collateral, use of collateral, and virtual vault. Ashish, did you have any other points to add here before I move on to the Q&As?
No, I mean, only thing we also need to look at the segmentation of the retail and the wholesale part. You know, every segment of the industry has a different need. And, you know, the coming future, we will see every segment behave differently. For that matter, let's say tourist retail will be affected more rather than, you know, the local Arabic clientele retail, which is, you know, serving to the Arabic clientele retail. So that way also the financing needs or the demand will keep on changing. And thus we need to look into all that. And whichever companies are able to, you know, get into the segments which will revive faster, will survive better, and will, you know, will be able to take the shock easily.
Excellent. Gentlemen, thank you very much. Let me ask some questions, and please keep the questions coming. We've got another 15 minutes to go. So the first question I'm going to ask is, Jeff, you've mentioned virtual vault. You've also mentioned RFID. The question is, what is a virtual vault?
Okay.
What is RFID? How do we make it work?
Okay, radio frequency identification device. Okay, a virtual vault is actually taking a store and securing it as though it were a vault, with that store being under the security control of a leading secure logistics service provider.
A custodian.
Yes, a custodian suggests that the product's being held in custody somewhere else. Now, this is about taking the store and securing it.
Yeah.
So you know all the product that's in there. You have 24/7 camera surveillance.
Yeah.
So the secure logistics advisor is watching everyone, and if it sees an unusual pattern of physical activity, then it's alerted. As in any good vault, there is insurance. Now, every jeweler has to take out jeweler's block insurance, but it could be that the jeweler that's taken out that insurance is the one that runs off with the gold. So then who calls for the insurance? Because then you have a problem. But the secure logistics company will provide backup insurance. So if that were to happen, it's still insured. So you have, you turn the shop into a secure unit, right? Not with bars, but with technology securing the unit, being under surveillance 24/7, and you're, as a bank, your collateral being insured for all risks.
Yeah.
And so you've created the same level of comfort that you would have if your product was actually in behind closed doors, is actually in the open. And why is that so important? Because the jeweler can sell those products in the normal way every day. And at the end of the day, would have sold a certain amount of product, and he can either pay the bank, I repay a bit of the gold loan, or what they call retag. Now, a tag, for those who are listening, is a very, just like when you see any piece of jewelry, you see a little tag on it that is like a barcode. It's just like that. And that has thousands of pieces of information. And those tags themselves give the jeweler tremendous amount of extra management information from which he can manage his business in a much more proactive and profitable way. Because look, I'm sure all jewelers around the world suffer from slippage, or, you know, some jewelry goes in. Under RFID, this cannot happen. I mean, to do a stock take, normally, manually, if a 25 kilo stock take probably takes all day, maybe 2 days. You have to shut close. You know, this can be done between 30 minutes and 1 hour.
But there's a question, Jeff, I have, and I'll ask this, I'll just bounce this off Manoj, for instance. Enforceability has been a problem, isn't it, Manoj? Because it means
Yes.
going through the courts, which is why the banks have been reticent to really wholesale adopt this.
Yeah.
Is that still the case?
I think that is still the case. I think we do have to either create, I think I like Jeff's idea, but it's more a question of creating some sort of a partnership around this virtual vault if required, because I think banks typically don't want to get into collateral areas where they don't normally go. And collateral enforcement always is a big issue in the markets. So I think with the experience and the other experiences banks have had in this area, they have been always reluctant to take that as collateral.
Right. If I can move on to the next question. Sorry, Jeff. Yeah.
Sorry. It's very important, because what you said about is enforceability.
Yeah.
Okay. Until recently, we didn't really have that enforceability, because we didn't have an electronic control of that enforceability, i.e. there's a financier, there's a borrower, and there is a secure logistics service provider who's actually looking after this. I mean, in any business, in any commodity business, you've got a warehouse, you've got an owner of the product, and you've got a lender. Okay. Now, we had a problem. How do we enforce this? Well, I can tell you that there is a product that a company that you were the CEO of, Mr. Gautam, that solved this problem.
Yes.
And it is, I mean, if I may say, it's called TradeFlow. And that gives, and there is case law now supporting the enforceability of RFID tag jewelry between the lender and the borrower. So there is case law and there is enforceability.
Fantastic. Now that's great news. Now, I've got a question from Manoj here. You talked about transparency. Now, the question here is, what if a company is already audited by the top 10? Now, what more are you looking for as a bank?
So beyond that would be the underlying schedules. Normally banks would ask for receivables, inventory, so the typical schedules which go with it. So if it is well audited, I fully agree. I don't think so banks would want to be unreasonable in that particular respect. All that they would do is, as part of their diligence, understand a little bit more around the sales, the details of sales. So because the audit is just around the numbers, so the numbers are clearly validated. So you just go what is underlying the numbers to see establish patterns and whatever you need. And I think if that is done, then the financing tends to become a lot more easier.
So it's a lot more granularity around what's supporting those financial statements.
Exactly. Yeah.
Right. The second
that's
question
not
that
also
I have,
a lot. Yeah.
Yeah, indeed. I mean, it forestalls a lot of problems in the future, let's say.
Yeah.
The second question I have is, you mentioned more equity on the table. Now, what do you see as a desirable equity debt ratio for this industry?
I don't have a data on really where the industry is, but I think debt to equity in the ranges of maybe 2.5, 3.
Right.
Would be what would keep the banks happy.
Right. Okay. Excellent. Good. Jeff, one question for you, which is, you talk a lot about the value of gold, the underlying value of gold, which can be used as collateral and so on. Yeah. But what about a retailer of fine jewelry how do they take advantage of this? Because they've got precious metals, they've got stones, they've got diamonds set in that, and it's not as easy to collateralize that.
Yeah. Could I answer that in a funny kind of way?
Mm-hmm.
So back in 2001, November 2001, I was called to a meeting with His Highness Sheikh Mohammed, okay, along with His Excellency Sultan bin Salman, to talk about the possibility of creating a commodity center, which eventually became the DMCC. Okay. Now, at that meeting, I probably spoke for an hour or so in a very relaxed way about the gold industry. And then His Highness said to me, okay, that's fine. Now tell me about diamonds. And my reply to him was, you need to speak to my wife about diamonds. She's the expert. I haven't got a clue. And so, look, what I would say is gold jewelry financing, pure gold jewelry financing is relatively easy.
Yeah.
I think diamond financing that we've heard is relatively easy. But when you combine fine jewelry with diamonds and gold, you're buying a piece of art. You're really buying something that's beautiful, and there's so much intangible value over and above the intrinsic. And so
the valuation is in the eye of the beholder.
It is. And frankly, if anyone's had bought a piece of jewelry that's very expensive and very fine, and you decide to try to sell it, the haircut is not 10 or 15%, it's more like 50%.
And I think that raises a follow-up question, Jeff, which is that in this market, almost about 60 or 70% of jewelry that is sold is diamond jewelry. So what you're saying here won't necessarily work. That'll work only for the 22 carat sort of jewelry kind of retailers or wholesalers.
And I'd say, look, 18 carat upwards, but definitely trying to evaluate fine jewelry that includes, a lot of workmanship and a lot of stones would be very, very difficult for a financier to ascertain the right fair value and haircut. And also because at the end of the day, what would you do with your collateral? You would liquidate your collateral. I don't know how you do that.
Yeah, and that's a perpetual challenge. Manoj, I've had a follow-up question to yours, to the one answer you gave. What does 2.5 to 3 equity mean? Translating in another way, you're talking about debt of 30% or less.
I'm talking total bank debt to equity.
Yeah.
Not total liabilities to equity. So not leverage, but debt to equity.
Right.
Just pure debt to equity.
So you would look at debt versus equity at about 30% or so.
Yeah.
Leverage. Okay. Excellent. Let me see what other question. Nirav, you mentioned normalcy by end 2021, right? Now, the question that's asked, I think, again of Manoj, they love you, Manoj, and the banks. As supports, what are banks seeing as support beyond December 2020 and the period of test? The question here is, should jewelers change their business model, keeping that bleak scenario in mind? I don't think you can give an answer to that. But really the question for me is, what happens after the end of this year?
Yeah, no, I think it's a very good question. And frankly, in my view, this is the crux of this entire discussion. Because, it's a very thought-provoking question. We are in a very uncertain world in terms of how the future is going to pan. What is essential for your industry? And I'm sure you can add 5 more things. I think you need trade, travel, tourism, hospitality back in full swing. And I think those of us who underestimate the pandemic, I think are making a serious mistake. You have to really step back. You read New York Times articles or other articles, and you will gather that social distancing in restaurants of 1.2 meters. You can't really sustain that. I'm not using it in relation to the gold industry, But I talked in relation to the gold industry, the wear and feel pattern has changed. So I think at this stage, I have been through many crises. This is probably my seventh in my career at least. But it is the most, it's the one where the unknowns are a lot more than we've ever experienced before. So at this stage, I think even as a bank, when we do deferrals, we're not sitting down and asking the customer difficult questions around what's your cash flow looking in September and December. I think we are going to cross the hurdle of when the graph comes down, when the growth rate, when it is better under control, you get to a new normal and you establish the flows. You know, you would have read enough articles about how many small businesses will get wiped out as a result of this. Yeah. Because Jeff made a very good point. I mean, that's very dear and near to my heart about the 12 months cash flow. I think he was being a bigger banker than me. I would have lived with 6 months cash flow. I would have accepted 6 months cash flow because that's the time you need to sustain today.
Indeed, indeed. I mean, I'm going to ask, there's been persistent questions in the diamond industry. I'm going to ask Ashish the question. Ashish, valuation, as we said, of diamond encrusted jewelry is difficult. Now, should the banks and would the banks accept international valuers? Now, are there such valuers, internationally reputable valuers that you can use and which the banks will accept?
See, in the European and American context, yes, there are a lot of international valuers. Even, you know, if you've heard of Delgado Finance, they are using international, valuers for valuing the diamond jewelry inventory. And even if I can name a few, like Association of Independent Jewelry Valuers, again, it is in UK. That is also an independent body valuing diamond jewelry. So those kind of, agencies can be used by the banks and the financial institutions to value the diamond jewelry and make it more bankable. Also, if the private equity funds, like Delgado Finance can do this, but definitely there is an option like this with the banks also.
I'd like to spring to the defense of everyone, actually. But look, a private equity fund is a very different animal to a bank. A bank has to have a conservative approach because a bank takes deposits in from its clients and lends some of those deposits to its clients on the other side of the balance sheet who wish to borrow. But they necessarily have to be conservative. It's what a bank is. It's the kind of, first rule of banking. You have to look after your customer deposits, look after your customers, and don't take unnecessary risk. However, a private equity fund is typically looking to get a big return on its capital. So its modus operandi is to take more risk. And so a private equity fund financing and being actively involved in the diamond sector would make more sense to me because it's high risk. Because simply the methodology of coming to a valuation and the acceptance, you see that private equity fund can appoint as part of its structure an international valuer.
Yeah.
It's part of its. It's part
of the cost, basically, of.
When you issue the memorandum, when you first want to, raise funds for the private equity fund, you actually define the risks. And one of the big risks is the valuation, whereas a bank can't do that.
I'm going to ask one final question of Manoj, and then I'll summarize it. And I'll ask a question to all of you before we close down because it's 3:30. Manoj, the question that I've been asked specifically for you is, will banks be open to reducing interest rates? So it's not about relief temporarily, it's about reduction.
So I think the question is, okay, I'll put it slightly differently. I think it's not the reduction which they are talking more on margins, because the rates have reduced in any case, and that benefit has been passed on to customers. So the absolute rate you are paying now is a lot lower than perhaps what you paid 6 months ago or 9 months ago. The margins are a function of risk. Risk clearly is at a much more elevated level today. So if you really ask me, can that be done? I think that will be, each bank will have to make a call on that. It can't be generic to the industry. And you talked about the transparency factor, etc. So banks also have a rating or a grading scale. As you go and fit into their grading scale, I'm sure there will be customers who can benefit from it, depending on where you come out on the grading scale versus not being able to benefit. But it's the margin really, so that the audience is clear. It's not really the rate. The rate is down for it.
And because of the heightened risk at the moment, as you're saying, that margin goes up, not down.
Normally it goes up. And you see, right now, all these eases which you have seen have been done for liquidity purposes. So I think it's an excellent move by the central bank on that respect. But if liquidity suddenly comes under pressure for any reason, you can have a change. And I think that's where you have to be prepared. Things, keep changing. And around this pandemic, there are discussions around the W curve, but none of us can really say where it is headed.
Okay, excellent. Which leads me beautifully into my last question. And I'm going to ask each of the panelists. I'll start with you, Neerav. A U-shaped recovery, a V-shaped recovery, L-shaped recovery, or a W-shaped recovery? What's your view?
I think consensus is looking at a W-shape rather than anything else, because there is chance of this coronavirus being, people getting reinfected of the people who have been cured also. And the spread of that cannot be contained in that sense. So there will be more of, we'll have to live with certain, as I call it, life with COVID rather than life before or after COVID. So there'll be a period where we will be living with it, with more social distancing and other norms being followed on a regular basis. And that also means that for the businesses to start having a factor in this kind of disruptions more often coming in next 3 months or 3 to 4 months, then just, okay, now the lockdown is done, so now let's get back to normal. No, that's not going to happen. We might have this again also. You never know.
So W. Manoj?
Yeah.
Your view?
My view is it's a W.
W again. So there's 2 W's already. Let's move to Ashish. Give us a different view, Ashish.
Now, being an optimist, I feel, if it's, even a U curve would be great for, the entire industry, yes.
Fantastic. Excellent. Jeff, what's your view? Contrarian.
Can I use a different letter?
Of course. Go on.
How about a J-shaped recovery?
Okay. Yeah.
Okay. Because I believe I'm like with Ashish. I am an optimist, and I always look for, even in the worst situation, the best thing. There's always, Manoj referred to this. Every cloud has a silver lining. Okay, and in this case, it could be a golden lining, because I think that the bounce, certainly in terms of the jewelry industry globally, could be a J-shaped recovery. Because I'm not just talking about UAE, because so many people now believe that didn't believe before in gold. Honestly, I was talking to one of the big companies that sell bars and coins globally. They have made their budget. In the first 4 months of this year, they've hit their 1-year budget. So this is from the general public, and the general publics around the world are buying gold. Now, once they're able to, and they want to buy gold, but they think it's boring to have a bar or a coin, I'm going to go and buy myself some gold jewelry. So I think the gold jewelry sector, I'm not saying the world, the gold jewelry sector could have a J-shaped recovery. And really, once we get into 2001,
Yeah.
To the moon, Alice, as they say.
And I think Ashish has more or less said the same thing, really, where he said where supply is throttled at the moment and there's not manufacture happening, when that recovery comes, it's going to be extremely fast.
Jacob.
So
Look
we're
at
all
it,
optimistic that we all hope it's not a W, it's a J curve. I'll end on that note. Thank you very much, everyone, for being a part of this panel. Thank you all for listening in. Thank you, TNJ, for organizing it, and Ashish for conceptualizing this. Thank you very much. We'll see you in future seminars, I'm sure.
Well done.
Thank you.
Gautam. Excellent moderation.
Thank you very much.
Yes.
Thank you all.
Thank
Thank
you.
you all.
And stay well.
Yeah.